There we go. All right. Good morning, everybody. It's Wednesday, February 19th, cruising through this month. I'm joined by Dwayne Gibbs. Good morning, Dwayne.
Good morning.
Good morning. I uh, I know we've got this event coming up here at the end of the month. We're doing a noteworthy event in Phoenix, and that got me thinking a little bit about who's going to be there, who's going to be the audience, that sort of thing. So we'll have note investors, real estate investors, private money lenders, kind of a whole variety of people are going to be there. I guess the common theme would be people looking for alternative investments, in general, with a tack towards real estate, which of
Yeah.
course includes real estate notes. And as a part of thinking about that, I thought today we'd talk about how we work with rehabbers, how we work with private money lenders, those sorts of things, because there's still a segment of real estate people that haven't even been exposed to the note industry. It's still just such a foreign concept to them, and it's still by smaller groups now, thought of as a niche in real estate versus mainstream, and it really can't be further from the truth. I mean, we're really in the financial side of real estate. And the way I used to explain it was, you got real property on one side and lending on the other, or real estate financing on the other. So we're all in the same business. We're just opposite ends of the same coin.
Mm.
When people realize that, they start to see more opportunities, right? I mean, that's when businesses can expand. So if you're in real estate looking to expand your business and opportunities, you need to understand the financial side of the business, which is the note business. If you're in the note business, you need to understand the real estate side, because you can see issues and problems there that you can come up with solutions to, and it just creates more opportunity. And Dwayne, you've brought a lot of people into this industry, and I know one of the examples we always can use is landlords, right? I mean, how many of those have converted?
Oh man, a ton of them. And the pushback I typically get is, well, I like having property. I like being able to touch it and have property no matter where it is. And I
Hmm.
said, well, if you're doing a non-performing note and you have to foreclose, you're going to get that property back. So, again, fixing it up. And if you decide at that point that you want to hold it and rent it out, no one says that you have to create a note on that and create seller financing. If you want to create that into a rental, you sure can. I mean, that's
Hmm.
up to you. So there is opportunity. No, the note business is just another segment of real estate: wholesale buying, fix and flip, renting, mobile home and land development, land tracts. I mean, it's all a segment, and so at the end of the day, being able to offer someone and being creative in your own right to help more people in creative financing. Once we explain that, and Kevin, we've had people that have flipped 500, 1,000 deals a month,
Hmm.
but they're a one trick pony. They have a bunch of cash at the end of the month, and now what am I going to do? How can I create longevity with this? Because I need income. And they're not looking at big picture. And then when we show them how to create paper and how to buy these non-performings and then manufacture a note on them again, and for generational wealth, that a light bulb goes off, because they just get tired of dealing with contractors and meeting appointments where they have to be on the other end of town, and they realize that this is a simpler way to create generational wealth.
Hmm. Yeah, exactly. And on top of that too, the we get asked all the time from note investors, how can I expand my business? How can I do more things? And you try to explain it's build relationships with other people. I mean, if you just met one rehabber, somebody who's flipping, 12 properties a year, 6 properties a year, and he's creating seller financing from that, that's 6 potential deals for you right there, or 12 potential deals right there. And just do the math. How many of those people do you need to meet before you have more deals than you know what to do with, or more deals that you can afford? And that's not a bad problem to have, because if you're getting more deals than you can afford yourself, that gives you the opportunity to bring those deals to other investors and make fee income, right? Buy the ones you can, and then, or the ones you can, or the ones you want, and sell the other ones and make fee income. And then you start to think of, well, who else? Well, private lenders. We've seen a surge of private lenders who do short-term bridge financing for people, 1, 2 year loans. And some of those folks are getting nervous because they see the properties not renovated yet, because construction cost is up, labor's up, lumber is up, as they say. And so a lot of investors are going, can't make any money on this thing. The prices have just squeezed me. So you've got these private lenders that are both selling non-performing type of private loans, but also performing. That scenario is not playing out everywhere. There's still people making money in real estate and rehab, of course, but it is tougher. There's no question, no question about it, because they look at the bottom line and go, man, I can renovate this thing, but it's going to sit on the market for a little while because interest rates are still hovering around that 7%, and a
Mhm.
lot of buyers are just going, crossing their arms, going, I'm waiting. I'm just going to wait and see what happens to the interest rates going on
Yeah.
here. But, so expanding and networking with other people is just a smart way to build your business, but at a minimum, your knowledge base. So here's a quick example for you on a rehab property. And it started as a rehab property, a fixer-upper, very common technique, obviously, in real estate. So there's a lot of rehabbers out there. And more of these rehabbers are utilizing seller financing to sell the property because, again, they need to attract buyers coming in here. A lot of buyers don't want to go through the bank rigmarole, may not be able to hit the qualifications. So a lot of these rehabbers are focusing on the so-called affordable housing market, and they're able to show people how to buy a house without having to go through all the bank stuff. And then they turn around and sell that that note. So here's the property pre-rehab, right? Pretty typical. You got the overgrown grass, a house that's going into foreclosure, probate. It's under distress, for whatever reason. And in this case, the house was vacated, and it was initially purchased as a fixer-upper, right? So very common. Somebody's going to go in there. They're figuring out, what's it going to cost me to buy this property? What's it going to cost me to renovate the property? And after I renovate it, what's it going to be worth? And what's my exit strategy? Am I going to sell it? Am I going to rent it? All those sorts of things they start to go through. Now, note investor, we haven't even gotten into this picture yet. This is just pure real estate investor that's looking to buy property like this. So property was purchased. You can see that's the deed and everything that was exchanged when they bought the property here. So all the documentation. They turned around and renovated this property and then sold it with financing. And by the way, sometimes you can buy these rehab properties and sell it as is with financing to another investor as well. So there's another opportunity there. But this is a $25,000 note, 25,501, kind of an odd number, but to be exact, it was written at 8.5% interest, which again is higher than bank rates, because in this affordable housing range, that's not always as sensitive to interest rates as um, above and beyond affordable housing. Right now, for example, in the US, even in Florida, even in Miami, which is so overdone right now, multi-million dollar properties are selling no problem. They're selling like hotcakes because it's not as interest sensitive. It's in that middle class, upper middle class. That's the part that's really rough, and they're the ones folding their arms saying, we're not going to buy. But when you get into affordable housing, it's not as sensitive to interest rates. It's more sensitive to, what is the monthly payment and can I afford it? That's the big key here. So the 8.5% doesn't bother in this price range here. So we got a $25,000 note, small note. It's secured obviously by a mortgage, and that's the difference there, right? The note is the promise to pay it back. Okay, that's all it is. You can see item number one there. A note is simply what? It's a promise to pay. And that's considered a personal loan, personal property, if you will. That then is backed up by a security instrument, as you can see here, security instrument. And the security the security instrument recognizes the note. So it attaches those two things together, and that's what makes this a part of real property. This is the document that makes your note secured by the property. Okay, improved or not improved. In this case, obviously, an improved property, meaning it has a house on it. Okay, the note was seasoned. So the person who created this note and sold it, they collected payments for a period of time. That's what we call seasoning. And that can be a smart thing to do in the big picture. If you don't need money right away when you create a note, season it out a little bit. Why? Because it makes it a safer, more attractive investment for a note investor down the road. And it actually enhances the value. Think about it. If you're buying a note and you've got, let's just say you have two notes and they're exactly the same, but the only difference is this one, the person hasn't made a payment yet. On this one, they've made 6 months of payments or 12 months of payments. Same amount of money, everything else is equal. Which one are you going to buy? We're going to buy the one that has the track record. It just makes sense. They've got a proven history of the ability to pay, where the other one, they haven't made a first payment yet. So naturally, you're taking more risk in a case like that. So they seasoned up this note, and the note you can see then was sold, and the price on this was 18,750. So I like using smaller case studies for people to wrap their head around it, so they're not putting themselves out saying, well, I don't have 80 grand to invest. You don't need 80 grand to invest in a note. I could show you case studies with that. In fact, I'm working on a commercial deal right now. It's a $226,000 note. So I can show you those examples, but I want to include everybody in here to show you, you don't need all of that. So if you are somebody looking for bigger notes, if it makes you feel better, add a zero to this, right? Or something like that, because it doesn't matter. I'm trying to show you that there's all different levels in this. So 18,750 obviously is a discount from the $25,000 loan. Now that $25,000 loan, that principal balance over this period of seasoning has gone down. But if you're making mortgage payments yourself, you know very well that most of the mortgage payment that you make, especially in the very beginning, goes towards interest, not principal. So that principal balance is going down pretty slowly here. So we're buying this note, or purchase this note, I should say, at a discount here, 18,750. And when you run the numbers, we look at safety first, we look at our discount rate, and we look at our yield. Those are the three big numbers when it comes to these performing notes. And by the way, notice the picture, big difference. You don't see that overgrown grass anymore. It's been repainted, been redone. You got all the inside pictures of what they've done on the property. So now the property's worth 62 grand. If you're in it for 18,000, that's only a 30% investment to value ratio, which means your investment is backed by something of much greater value. Your investment's only in the value of the property for 30%. So you don't have to be concerned with the ups and downs, the peaks and valleys, so to speak, of real estate prices. You're not as sensitive to that because this property could drop 10% in value and it's still worth, what would that put it at? 50 something thousand dollars. And you're still only in it for 18. You know what I mean? It could go down 20%, which would be a huge drop. And that means there's major things going on in the economy. And it's still worth 40 something thousand dollars. You're in it for 18. So you're down here, and the waves of prices for real estate are not really affecting you because you're in it for such a good investment to value ratio. Now you're only paying 90% here of the balance of that loan. So you're getting it at a discount. So if this loan were to pay off early, you're getting bonus yield on that. But in the meantime, you're getting 11.3% on your investment. And again, I challenge anybody to email me, email Dwayne, info at kevinshortell.com, and say that you have a better investment where somebody can invest $18,000 and have this kind of safety and this kind of return. I don't think it exists. I just don't think it exists. So that's a great way to start to work. So imagine, once again, to go back to our opening here where I said hooking up with an investor who buys properties like this on a regular basis and creates paper like this on a regular basis. What could that do to your business in the future? What could that do to your investment return? Just that one
Yeah.
relation. right?
Absolutely.
So let's see. Oh, by the way, on this one, when we looked at the payment history, the person was making above and beyond their
Mm,
required payment. Okay, so they were paying extra money every single month, which adds to your return, by the way. It does pay off the loan sooner, that's fine, but it increases your return. But when we buy on this, they're not required to make this extra money. It's voluntary. So you have to buy it on what their loan amount, what their monthly payment is, not what they are particularly paying in this course. So it's a little bit of an adjustment of how you look at it. But it was interesting because I ran the numbers on a financial calculator here. So those watching on video, you can see this. Those that are not, I'll try to describe this for you here. They are paying $500 per month, which if they continue to do that, would shorten this loan by about 50 months. Okay. So yes, they're paying it off sooner, but they're also paying more money, and that's going to increase your yield. So if they continue this monthly pattern of paying $500 a month instead of the required payment, where's that required payment? Uh,
go back one.
Back one more or forward one more. Did I just pass it?
Yeah. No.
No. We'll figure it out. So whatever, if they continue on this pattern, yes, it'll shorten the loan, but your yield goes up to 14%. 14% yield on this thing if they continue that pattern. If they don't continue that pattern, if this was just something where they did for a year or something and stopped and went back to their regular monthly payment, then let's see, that's 8.5, 20. Oh, okay. Yeah, 14.16. Ah, shoot. I don't see what that regular payment is. I'd have to go back and figure it out. I put that on the computer wrong here. But so the payments are not $500 a month. That's not their required payment. It's 380 something, something like that. And they're paying extra money on that. So with that extra money and shortening it, but your yield goes up. But even if their yield, excuse me, even if they don't make that $500 per month, your yield on this thing is still going to be 13%. Yeah, I'm sorry, 11%. So 11% if they continue to make that regular monthly payment, and it's going to be 14%, significant difference if they continue to make the $500 a month. So again, either way, you're making a double-digit yield. Your safety is backed by the fact that the property is worth substantially more than what you have in it. And when you think about it, your risk goes down every single month. Every single month they're making this payment, plus the extra is decreasing the amount that you're in this loan. Even if the property doesn't appreciate anymore, your risk is getting lower because the amount that they owe you is going lower and lower. If the house is appreciating, it just accelerates that as well. So as you go through this investment, your yields are solid, but your risk goes down on a regular basis. And again, how many of these properties is this particular individual doing like this per year? Build that relationship. Working with private lenders, is another thing that we do. So a private lender, this case here in Maryland. So this is a little bigger property here, a condo. This was an investor-owned property, and so on this one, it's the same premise where a private lender came in and actually owned this property and turned around and sold it with financing. Okay, but they did it on more of an investor term, a shorter rate, shorter loan term on this deal, as you'll start to see here. So the sales price on this one was $165,000. And of that, 132,000 was seller finance. So they got a pretty good down payment there, $33,000, if I'm doing the math correct. And they wrote that at 12% interest for 5 years. So different type of loan. This wasn't a loan seller financed to a consumer. It was really sold to an investor on this property. So Dodd-Frank and all that sort of stuff does not apply in this case. In the first example I showed you, that one was seller finance to a consumer. This one is an investor who has done this seller financing deal. So 12% interest, 60 months. You can see the payments are $2,900 per month, and the borrower brought $37,000 to the closing when you add in closing costs and everything else. So good down payment, solid. They're willing to pay 12%. Why are they willing to pay 12%? Because the property did need some work. They're going to fix it up, and they're going to cash out of this loan. So this particular lender, once again, collected 12 months of payments. And so now that real estate investor who sold it to another investor is now the note owner, and he just decided to sell this note, after keeping it for 12 months. At that point in time, the balance once again has dropped, right? The original balance on this was 132. After a year, that balance dropped to 114. Had title insurance on it. We looked at proof of payments. We looked at proof of insurance. We looked at all of the paperwork, and we entered into a purchase and sale agreement to buy this property. To buy this note. So this is a deal that I partnered on, which is another level that you can add to this. You can stretch your investment funds by partnering with other people. So in this case, I partnered with a client of mine to do this deal, who brought it to the table. So again, we got all the paperwork. We signed a purchase and sale agreement. We got the assignments and the allonges and everything else that we needed here. And we started collecting payments. And oftentimes on these more investor type of loans, they're paid off early, right? Because the investor knows, yes, I'm paying 12%, which is a premium. I want to get out of that loan as quickly as possible. So as soon as I renovate this property and have it rented, or whatever the case is, I do my loan applications, I want to get out of that high interest rate loan and get a regular loan now. Okay. This is different than the first one I showed you, which was a consumer who was paying 8.5%. Okay. They're not as anxious to get out of that 8.5% loan because they're really looking at long-term payments to stay in the house. The mentality is different. An investor paying 12% on a very short 5-year loan wants to get out of it. So it was no surprise to me that we got a call. I don't know if we received a year's worth of payments, maybe a year and a half, something like that worth of payments. And then they sent us an email just saying they're selling the property. That's how they cashed out of this loan. Remember, it's an investor who renovated the property, made it nice again, put it on the market, takes a little while for the property to sell, and turns around, sells the property. And as a part, of course, of the sale, they have to pay off the underlying loan. So we got that email in January. By February, end of February, we received the total payoff here. And when I ran the numbers and gave the instructions to the title company who was handling the sale, my partner made just over 12%. I made over 13% on the partnership arrangement that we had on this deal. So everybody came out fine. The investor paid off their loan. They made money because they sold the property at a profit. The original investor who carried the paper, they got their money out of the deal. We did good on the deal, and everybody was happy. So these are things that you can do and network with private lenders as well. Private investors that work business to business. You can work with investors that work business to consumers and build those relationships and do multiple deals with them. Dwayne, thoughts?
Only thing I have to say is, if you're a real estate investor, you're a wholesale guy, I would look back and say, how many deals over the course of last year did I pass up because I was not able to offer seller finance because I didn't know what to do, or I needed a different strategy versus just wholesaling the property and getting it off my books to somebody else. What else could I have done? And, I know the answer, the answer, we hear it all the time. Daggone, if I would have known this or have done some of this, I probably would have been able to do anywhere from 4 to 6 more deals last year. And I'd say, go back and look at the deals that you weren't able to do, and consider doing this in your model and see what that looks like for you. And we have all the time, as you know, people say, daggone, 4 to 6 more deals would have really changed my bottom dollar of what the company would have made. And so, it, it, you know,
Yeah,
it's a
yeah,
turning,
I
it's a
agree.
turning point for a lot of people.
I agree. And the other part, remember too, is if you're thinking, well, that would be nice, but I don't have the money for another five, six deals a year. You don't need it.
That's
If
right.
you would have brought those notes to me or to Dwayne, uh, you could have made a broker fee on that. There was plenty of room in those deals to make a broker fee. And what's a broker fee? Well, um, we don't typically call it a broker fee, but that's really the description of what it is. A broker is putting buyer and seller together for a fee. We kind of avoid that terminology. We just call it fee income. But here's what it is. You find this investor, right? And they tell you, going back to this one, they tell you, yeah, we created this note here, and here's all the terms of the note. We created it for 132,000. The guy brought $37,000 to the closing table. It's at 12%, 60 months. There's only 50 something months left now. Would you be interested in buying that
I'll
note?
find
Yeah,
you a buyer.
we'd put a price in there, and you would make some kind of a fee on something like that. That fee on a note like that is typically, give or take, around $6,000. And what did you do? You just had the network already set up. This person brought a note, you brought it to a note buyer, put the deal together, and you made 6 grand. On the other note, obviously it's a smaller note, so there'd be a smaller fee involved with that note. You're not going to make the same fee on an $18,000 note as you would on a $100,000 note, but there's a fee in there. You know,
And
and
over
that's
the years that we've talked to all these students, I mean, tens of thousands of people that we worked with, a lot of them are looking for that don't have the capital to go out and purchase a note. They all start out like trying to create fee income.
yeah, that's where I started. For sure. It's funny. I put together a presentation for my state of the industry address that I'm doing at Noteworthy, and let me pull that. You might get a kick out of this. So I'm going through all these stats. I'm looking at all the um, different opportunity. What's going on, the good, the bad, the ugly in real estate and real estate notes, and I put together a little slide here. I think you'll get a kick out of.
You
Um,
love doing that, don't you?
I
I'm glad you're doing it.
I mentioned I started with brokering notes, getting fee income. That's really where I started, and I put this. So you'll get the preview here, everybody. So this is one of the slides. So you know when I started, I didn't have capital, so I started with seller finance notes, and I would find the seller finance notes, bring them to note investors who had the capital, and make fee income. So to your
Yeah.
point, that's what I did. That's what I started, and that's really what the industry was all about. And what I have up for those who aren't watching the video and just listening, I have a picture of all the presidents from when I started. So it started in the Reagan administration, then Bush, and then Clinton, then Bush Jr., and then Obama, Trump, Biden, and now Trump again. Been through all of them. Started with seller finance notes, non-performing notes started to occur during the Bush administration, and then through Obama and Trump, we were coming out of that. And then performing notes and seller finance notes, started kicking in, and that's been the inventory and that sort of thing. And then, of course, leading into the second Trump run here, who knows? And I got a little question mark on the slide here, and I'll talk to that point. But that's the thing. It's not the economy. It's not Republican, Democrat, who's in the White House, any of that stuff. It's the industry that you're in, and identifying what are the best places for me to position myself within that. That's what determines your outcome, right? It's not the environment. It's the strategies that you apply through this economic environment. So again, I don't care, about the political discourse and who's in charge. And I think, Dwayne, we probably got together, right, I guess on the second Bush Jr., right after Clinton, I guess is what it
Yeah.
is. when we
Yeah.
first kind of got together, and that's when the non-performers were kicked in. And back then, all we did was focus on non-performing. So today, more of the marketplace is just what I showed you today. It's these notes that are being created because there's a tougher environment for investors and for consumers to get loans. So you go in there with a solution. These real estate investors create the paper. These real estate investors need money for what? The next deal. So they have to cash out of these notes, right? Sometimes they'll season them for a year. Sometimes they'll sell them before the first payment. I'm going into contract today on a note where they did the same premise, albeit on vacant land. And now, before the first payment was made, is when I made my initial offer. They've received the first payment, and so we've adjusted the numbers a little bit, and I'll buy that. That note has no real seasoning. The first payment now has been made, but when you think about it, only one payment's been made versus these examples. But this is the second note that I'm buying from that same person.
Mm.
Okay, that same investor finds discounted vacant land, and because foreclosure, probate, all the same things. It's just a different product behind it. But this is the second time I'm buying a note from them. And I like the way they do it, right? So again, building those relationships, looking for these investors who are creating paper, that's a big part of the trend right now. And that provides a lot of good inventory for you. So again, I put up Dwayne's Calendly link for you, because we're always looking to talk with people about the industry and what we can do to help you within the industry, because there's nobody doing it like we do it. We know all the other people, all the other courses, all the other ways to approach. But I'll tell you what, the way that we do personal mentorship, there's no substitute for working with someone of my caliber one-on-one with you with a common goal. That's what we do, and the results are what you would expect, versus you just trying a new business on your own. The results are quicker, they're better, they're safer. It just goes on and on. So give Dwayne a call. You can schedule an appointment. Just go to calendly.com / Dwayne Gibbs NMS. Dwayne Gibbs, Gibbs, NMS. It's on the screen. I'll also include it on the link there. And set up a call with Dwayne. Let's just talk about it. There's no cost or obligation for the call, or just calling. We're just talking to see if this is the right fit for you and answer any questions that you have. So we enjoy doing it. We've been doing it a long time and have put probably more people in this business than anybody.
Mm.
I say probably. I'm pretty positive that that's the case. But so that'll be on your screens there, and that's all I got for you today. Dwayne, did I miss anything? You had any other thoughts?
No, what people have to realize is, just because you're doing it a certain way, market changes all the time. So you have to change what you're doing to the market. The market is not going to shift, not going to change because you don't like the president in there. I don't like this property and I don't want to work with this. You have to figure out how to be creative in this market. And Kevin, hats off to you. You do a great job one-on-one with people of being creative, how to restructure deals, how to look at something differently. And let's face it, you've been doing it 30 years. I'd say you have a little bit of experience. You're doing the business every single day. You have a lot of people out there that are saying they're doing it, but you're doing it. You're partnering with students, and just, constantly closing deals. You created a lot of relationships with hedge fund companies that want to come to you, work with you because they know you're closing deals. And so hats off to you. I would tell people that are listening that be aware of what your market is and not be a one-trick pony, and realize that I have to change what I'm doing to create a better bottom dollar for my business.
Yeah. To put a pin on that, markets don't dictate your results, your strategies do. So focus
Right.
on the strategies and you'll be good. So thanks everybody. Look forward to talking to you all again next Wednesday.